As a systematic trader, it's not like you're actually out of the decision process. It's people have this misconception that you're going to create a system and then like it just runs. You still are making decisions. You're making decisions about, if nothing else, when to turn it on, when to turn it off, how much risk to put on. But it's a decision that is made a step removed from the market.
What's up everyone, welcome back to another trader interview here on the channel. Hope you're doing fun as always, hope you're doing good. Today I'm sitting down with Adam Grimes. Adam is the kind of trader I really respect for his dedication, his hard work. He advised trading only based on data, and a few more things that you'll learn about in this interview. Someone who went through a big journey of working in a different field, transitioning to trading and becoming really successful at it. So without further ado, hope you enjoyed this, and let's dive right into the interview. So what's been going on since we last spoke, since the past few years?
Well, it seems like we lost 2 years with COVID and everyone in the US being locked down. It's been, in some ways, it feels like I've kind of been stuck over the past year. And so I've recently, and we talk about some of the other things I'm doing, but I've recently just forced myself to start doing some more creative work and some more writing and stuff like that. Markets have been kind of interesting. We've seen some things that have just never happened before. One of the things that I love about people who do market stats, we always talk about, oh, this is a 1 in 10,000 year event, but something like that happens every 2 or 3 years. So, maybe there's a problem with the way we look at markets mathematically, but we've certainly had a reminder that, as much market activity as you think you've seen, the sell-off we had in 2020, and then the recovery is just literally unprecedented. I don't use that word lightly. And I think we've also gone through, I know you focus mostly on currencies. We trade a little bit of everything. And we've seen, I think over the past couple of years, we've seen some real shifts in the way currencies are trading, at least not trending, not extending the way that we usually see on higher time frames. And I don't know. So it's kind of, I guess, a lot of indecision out there and a lot of moving pieces. And I think it'd be very interesting to see if we have this conversation again in a year or two. It'll be interesting to see what happens over this next year.
Yeah, definitely. So how do you adapt to, let's say, the currency market not moving as much as before? Do you change strategies? Do you go to the other markets, or how do you deal with that?
It's a complicated question because a little bit about my trading style, people don't know. I'm primarily a discretionary trader, but I'm a weird discretionary trader because I do a boatload of statistical work. And I've done quite a bit of systematic trading in the past. And honestly, my trading, I for personal reasons, I want to move toward more systematic methodologies, less discretionary, but I've been for the past decade plus highly discretionary. Now, I would tell you that nothing has changed. I would tell you that, I trade the same way that I traded in 2000, 2005. But I think the reality is, as a discretionary trader, you're making all of these little micro adjustments all the time. And, where if you're a systematic guy, okay, so I have to refit this parameter, the system isn't looking so good. This one, so you're very aware of the things you need to push around. But I think even a good discretionary trader, you don't always know that. So one of the things that, in looking very carefully at what we've been doing, it's really a matter of reducing expectations. 4 or 5 years ago, I was a big believer, and I trade primarily pullbacks and trends, sometimes breakouts, but generally speaking, they're breakouts from already trending markets. So I would say that everything I do is some variation of a flag or a pullback trade, some kind of consolidation. And I also don't think there's too much nuance involved with the pattern. Like, it's one pattern's not necessarily better than another if you understand the structure. But we typically would put the trade on, and I tend to be kind of an all-in trader, and then would look to piece out of it as the market moved. And the beauty of that is that if you do that right, you'll catch these gigantic winners. And I still remember, I don't remember when it was maybe 6 years ago, but I had some stupid trade in the euro that I just kept moving my stop up, and I ended up making like 30 times my risk on the trade. And that feels really good, right? But of course, in the calculus of doing many, many trades, it's not that simple because you don't make that 30R on your entire position. Obviously, it's you piece out of it. So you almost have this little token position on that then you're thinking about all the time. So you're also devoting too much of your mental energy to this position that's really not economically significant. But we've really shifted from that type of piecing out to catch a trending market to taking full profits at 1R. So, what that means in practical terms for people, if you're risking $1,000 on a trade when you have $1,000 in profit, you get out of the trade. And it's not like you put a trade on and either you make 1,000 or you lose 1,000 or, whatever amount you're risking, because you will move the stop. So most of your losses, you'll have losses that will be, 0.4, 0.6, break even. You'll even have some small wins where something might go almost to your profit target and then you tighten it. So your stop is you actually take 0.2 R out of the trade. But that is something, this idea of taking, and Tom, my trading partner, was the one who convinced me to do this. And it took us a while. It's a pretty big shift, because you're giving up all potential to hit a home run with a trade, but the compensation is that it really evens out the uncertainty in the equity curve. And that's something that it's definitely an adjustment that I don't think I made, because I made that before the markets really changed, but it was a fortunate decision to have made, because it also, if somebody is struggling, the answer of lowering your expectation is also, I think is realistic in these markets. And then also in general, my stops have become a lot tighter over the past decade. And I don't know, it's difficult to say. I don't know if these things are necessarily a reflection of the market or of me as a discretionary trader. You can't really tease those apart, but that's part of what's worked for me. So what have you seen? What have you changed? What adjustments have you made?
Yeah, same thing. So like you mentioned, for me, it's more about kind of managing the trades more tightly. I used to, like a couple of years ago, I used to take I used to move my stop loss to break even really, really quickly at like a 1-to-1. So really quickly for my kind of trading. I kind of cut that for some time and I now kind of went back to it. So now I do the same thing as you do pretty much, which is I move my stop loss to break even really fast. I still have like these 2-3-to-1 rewards, but these don't happen as much as before for sure. So it's definitely a big, big change in that case.
The challenge, and we can talk about whatever you want. We can talk about psychology. One of the observations that I'm hitting on very hard over these past years is that trading is constant regret. No matter what you do, you're not happy. If you have a winning trade, you wished you held it longer. You wished you had bigger size. Of course, losing trades, or so there's always, you really can't trust your psychology, which I think is why discipline is so important. If you just followed your emotions, who knows, what kind of trader we would be. But with taking trades off at 1R, when we started doing that, there were many times where the trades would extend past that. And I experienced a sense of regret that we had taken 1R. It would have been an easy 3R the next day, but not so much over the past year. Now a lot of times there are exits that just barely tick the exit, and we're very happy to have been able to run for those exits.
Yeah, that's a good point. So 1R for a trend trader is like really, really low compared to what you were doing before for sure. So I know not many people would want to do that because they would like decrease their risk. But on it, like my third aspect, is definitely better to have tighter take profits where you are right more often than before.
Well, there's also, there's that. One of the things that I have people do when they start coding, when they start developing systems, and people don't realize that, I'm sure you do, the distance between your entry and your stop, and then your entry and your target. So we're looking at here's 1-to-1, 1-to-2. That is going to play in directly to your win ratio. So, for instance, there was, I lived my life like this for many years as a day trader. My risk was actually a lot bigger than my target. I was trading with risk 3, even sometimes 5 times my target. And of course, if I didn't tell you that, and I told you I'm an 85%, 90% profitable trader, you'd be like, oh, wow. But of course, the way the math works out, those losses do offset some of the gains. And so I think people can kind of craft maybe some of it's psychology too. Like, if you want to be a trader who is right more, then you take those smaller targets. If you enjoy the reward of the bigger wins, then you can stretch for some of those. And there are some styles where you really have to have those 15, the 15 baggers, even sometimes the turtle trading, approach, which I think has been really hard for the past 15 years or so. So that's just not something we contemplate in our universe, really.
If you think about it, for like a new trader who isn't super confident yet, and they try to do that, they might end up like having so many losses that they just quit. They don't want to do it anymore because it's like too many losses in a row, and for them it's just not worth it. So
yeah, or they may be very disciplined in taking the first 10 trades, which of course are 9 out of those 10 are losers. And then they start skipping trades. And of course, the story, there's 1 or 2 trades that make your entire year, and they will have skipped those and they'll have completely blown their entire year. So you have to be really disciplined about that. It's there's no easy way to trade, as you know, but I think that must be one of the hardest ways to trade.
Yeah, for sure. So you're someone who likes cooking, you like music. Those are like creative aspects. Like you're able to express yourself. You're able to add some creativity to it. Where is creativity in trading? Can you still add some touches of that to trading, or is it? Because people think it's like something where like you're super mechanical. You enter trades, you follow your process all the time. How does creativity kind of play a role in trading exactly?
I think it depends how you define creativity. I was listening to a psychologist who had basically created a creativity inventory, and his argument was that the vast majority of people, like 95% of people, are not creative at all. On the other hand, you think about it, like creativity is certainly anytime you solve any problem, anytime you whether it's a relationship problem or you negotiate something at a store, or certainly you figure out a piece of code, you figure out, some elegant way to solve a problem, to increment a counter or something, all these little details. I think there's a lot of creativity. For me, as you mentioned, my background, I cooked professionally for a few years. I served an apprenticeship with a French chef in America. So I learned kind of the main line of the classical French cooking tradition. And that's just a hobby now. I miss that. And in some sense, I think that would, sometimes I think that's the career I was supposed to have, but it's a tough life. It's a really tough life. And my formal education, my first career was I was a professional musician, pianist, pipe organ, harpsichord, and also a composer. And I did not do, for about 10 years, I didn't do any music. And then I have returned in the past few years, and I'm composing very actively and also playing a little bit more actively. So I don't know, we'll see where that goes. But for me, I think the real tie-ins are maybe, there's one that's a maybe and one there's a sure thing. The maybe's pattern recognition. The sure thing is work ethic. And for maybe there's something about how a musician is exposed to patterns. Because if you think about it, you quantify things in the market, but there's still a range of things. You're still, and your trading ideas, even purely systematic traders, there's still some point where you look at the market and you say, maybe we should look at this. These ideas don't just fall out of the sky. And I know about the machine learning genetic algorithms, and from everything I've seen, those haven't been super successful. For those that don't know, it's basically you tell a computer to test everything, and the things that look good, it'll follow more down those paths. So it's kind of it's called genetic because it's basically a process of elimination. But there's something, certainly music, and a lot of the music that I play is extremely pattern oriented, and you have patterns that are stretched and broken and come back in different ways and are twisted around other patterns. And there's something that might be very similar to what happens in the market. I was very surprised after I took about 10, 12 years away from music and came back that I expected basically my skills to be completely gone, and they really weren't. I was shocked at how much was still there. And, when I talked to some of my musician friends, they're like, well, you've basically been doing patterns. You've been doing this in a different way. And, I don't know, maybe there's something to that, but I don't think that's, for people wanting to learn to trade. I don't think I wouldn't suggest musical training as a way to bolster your market skills. But the other thing certainly is work ethic. And, as a classical musician, when you're young, you're spending pretty much right away 3 to 4 hours a day in front of your instrument. And if you're going to get to be any good at it, you're spending 6 hours by the time you're in college. And when you're in college, you're not out drinking and doing stupid stuff quite as often as everybody else. Hopefully you're still doing a little bit of that, but you're spending 8 hours a day in front of your instrument. And that degree of focus is not normal. It's not the way most people live their lives. So then when you come to trading and you realize that it's something that you really need to bring focused attention to for extended periods of time, I think maybe the work ethic of being a musician dovetailed nicely. And maybe there's more. I think I'm humble enough to know that I don't know all the cognitive pieces that work. Maybe there's some more magic there, but none that I'm aware of, at least.
Interesting. And I got to hear more about this. You mentioned the fact that AI didn't really work that well recently. Now, why is that? Because the logic works. Like AI, you do more of what works. It's supposed to get good results. Why wouldn't that be working, in your opinion?
When I started trading, I had zero quantitative background, and my education path, which ended up, I did an MBA at a school that let me basically substitute a lot of PhD coursework for my MBA courses, because I wanted to see, like, what are quants looking at, like, how are people, and I still, I have respect for the people who have pure math skills that far exceed mine. And I work with some people like that, and it's humbling. But one of the things I've always been worried about, I think many traders are worried about this, there's this rise of the machines, right? You have the idea that computers are going to be able to trade perfectly, and there's going to be no place for a human trader. And when I came into awareness as a trader, which was the mid 1990s, I knew nothing about markets before then. I saw that people were very concerned about neural networks. And this went back, you would read, even back in the 80s, people started thinking about that. And we keep seeing this come up, people certainly talk about HFTs, they talk about algos and all of their different forms. And there are many, many firms that apply, and there certainly are domains where machine learning is very successful, but we work with some of these firms. One of the lines of businesses that we've had over the years is providing signals to some big hedge funds. And these are signals that, that they will still pay, despite the fact that they can easily spend tens of millions of dollars on a server and hire whatever army of programmers they want. They still pay a guy like me for trading ideas, for algorithms that are built from my observations of the market. And I think, will this always be the case? I don't know. I think that there are things that we have this big, wet, soft computer in our heads. And there are things that we cannot compete with the machine. If you go up against the silicon brain in a speed test, you're going to lose. You're going to lose badly. But I think there are ways that humans process patterns that we haven't yet been able to replicate with a machine. Maybe that will change. I don't want to say never. I also suspect one of the problems for the machines is that despite the fact that we do a lot of quantitative work, and I was coding before we started this conversation, I was running a statistical test, and it's just a big part of how we live life day to day here. The market's not a math problem. This was a revelation I had walking around after a losing trading day. I was walking around lower Manhattan and just thinking like, okay, what am I missing? And that was an observation I had. I just realized the market is not a math problem. It looks like a math problem. It looks like a math problem because the market generates information and that information comes to us in the form of numbers. So of course, it looks like a math problem, but the process behind those numbers is a very emotional process. It's human behavior driven. It encodes, certainly there are mathematical aspects. When I say it's not a math problem, I'm not saying math is useless, but I'm saying the true essence of the market, if you will, is a psychological behavioral problem. And with math, we can make great inroads with that. Machine learning does have a place. There are certainly ways, we can run simple optimizations to figure out what we should do with some of our trading parameters. But the essence of the thing is it's a battlefield where humans meet, and every trade is a disagreement over price, and people fight it out. Yeah, I think that is, there may always be aspects that may resist quantification. Another thing to consider, and there are certainly ways of dealing with this, and some people are going to be flabbergasted by what I say here, but one of the limitations is the amount of data we have. There's really not that much data. And that's that's a puzzling thing, because you think about, well, okay, but what if I'm looking at tick charts? How many years of tick charts? How many, millions and millions of data points are there? But if you look at other disciplines, like for instance, particle physics, if you look at a single impact in a particle accelerator, that impact will produce many, many orders of magnitude more data than we have in the entire history of financial markets. And there's also the problem of extreme correlation. All of these things are tied together. And when I say correlation, I mean that in a very sloppy sense. I'm not saying correlation studies, but I'm just saying that if you look at what has happened over the past few years, we had COVID, we had recovery from COVID, we had slow economic recovery. Now we have uncertainty. And, we could go back every year, there's an event or two, and these macro drivers bring volatility and direction into global markets. Everything is tied together. So if I'm analyzing, say markets that you think might not have a lot to do with each other, let's say I'm looking at sugar and the Japanese yen. And, you might think that, okay, so those are pretty separated markets. And in fact, they, in some ways, are maybe more connected than we think. They still lived in that same macro environment. And we still only have so many events over the century and a half we have of good financial data. And the modern financial data starts where, 80s, maybe 70s currencies, you don't see currency data from the 40s and 50s for a reason, just those markets didn't exist like that. And so I think the limitation of data may be something that our brains can deal with better than the machines. Could be a different story next year, but I doubt it.
That's really interesting. So how do you then go about developing an edge, knowing that, let's say, AI wouldn't work and you can do it discretionary? So how would you go about creating your edge in that case?
Well, I think that, so we like to think that, as I said before, we're trading principles that don't change. And one of the few principles of financial markets that don't change over what I've been able to look at is the full history of markets. We'll talk about that in a moment. Markets have to move from price level to price level. Basically, markets exist in broadly one or two phases in a trading range or a trend, to use terms that everybody knows. And if you're going to trend, you're going to have to get from one price to another in some way. And that in some way has always involved movements in the direction we're going, and then pauses, and then pullbacks and consolidations. So that's why we have chosen to focus so much of our trading around this idea of pullbacks and consolidations and trends. One of the other things that I think markets have always done, there have always been overshoots. There have always been emotional overshoots and panics, whether it's to the upside or downside. Markets will become volatile. And there are also some predictable regularities and volatility. Markets will tend to go too far and then come back. And there are some topping and bottoming kind of formations that we associate with those. And like I said, we don't really have a lot of data, but there are data series that go back to the Middle Ages and even before. And if we look at the way price behaved then, and so we're looking at commodities like barley and things, we see many of the same patterns. And I suspect that you could have traded barley in Europe in the 13th century with some variation of the approaches we use today. And that's why I think that this must cue into some fundamental aspect of human psychology, how humans react to risk and opportunity, fear of missing out. You go back far enough in history, and at some point people stopped walking around and they built cities by rivers, and there were merchants who traded things, and the price of those things changed, and we've been doing this for a very long time. And I'm guessing that even those very, very early traders and merchants probably reacted the same that we do today when Bitcoin starts to crash or explode. It's probably still that same emotional reaction. I don't know. I'm talking about stuff I don't know. These are things that it's interesting to think about. I do think that there is, there's probably some practical application when you think about trying to apply these big picture principles. And then also, the other piece of your question is appropriate humility. That anytime traders experience this subjectively, but it's reality. Anytime you start to feel really confident, the market's going to adjust that confidence. And usually it's because our behavior is not correct. And I think just remembering that even though you have a system that has worked for years, and no matter what your P&L is, that you are still vulnerable to making mistakes, and there's always the possibility that the market will evolve, and there's always the possibility of some crazy black swan tail event that will cause an outsized loss. So this is why, we all, how many times a day do you say the word risk management? And it's not just talk, this is why risk management is so important, because it's what keeps us in the game. And if you think like that, I guess it's kind of an abstract answer to how do you find an edge. We could go more specific if you want.
Yeah, I'm just curious. Do you feel like as time goes by that, there's been like charting platform, more people joining the market. Do you feel like trading has become more complex over time, or because like back in the days, like in the 13th century, you would just like buy the price if you thought price will go up, and then that was it. There was no charting, no software, no tools, no indicator. Do you feel like this is making trading more complex, or do you feel like you can still be simple these days in trading?
Well, this is what's interesting to me, because if you go back to these previous periods when nobody was charting, certainly nobody was creating a moving average. And in fairness, we should also say, before people get excited and go dig up this old data, it's really messy. And the way the data was recorded was more like a point and figure kind of chart. So, there was nobody was interested. Paper was expensive, or we actually have some of these earliest records are on clay tablets. I'm sure that was very expensive. So nobody was interested in making a mark on the paper every hour or every day. So what they did, they would record when the price changed a lot, which, if you think about it, is a very elegant solution. You know that barley is $10 right now, and if it's $11, if it's $9, I don't really care. We're not going to talk about it. But if barley's $15 someday, I'm going to write that down. I'm going to write down the date. So what we have are big price changes. When who knows about data integrity? We can even begin to assess, but it's not really possible to even calculate those indicators. But the interesting thing is that from the best we're able to reconstruct, it does appear, when nobody was using these tools, that a lot of these tools probably would have worked. And I think this is the best time to be a trader. Everybody's always worried, like it's died down a lot, but everybody's talking about the HFTs, and we're really worried about, all the machines stepping in front of orders and everything. But when I haven't been doing this that long compared to some people. I started trading in the mid 90s, but even then you had to have two phone lines. So, you had a phone line, and it was a dial-up modem. So the old school modem sound while your software connected and pulled data through it, 2400 baud. And it just, I can't even imagine of course, the computers couldn't have handled it, but it would have taken days, probably weeks, to transfer a single video like we do today in a second. So the data was so much slower, and then you had to actually pick up the phone and call the floor and speak to a person to make a trade. And there would be many times, if you're trading actively intraday, that you wouldn't even have the fill back, and you'd have to get out of the trade. So like at some point, I don't even know what my position is. And today everything is so clean. There's so much access to data. There's so much of, it's not really an advantage, but it's a level playing field. And even, like for people who want to do fundamental work, Bloomberg is still kind of the gold standard. There's some competing, but pretty much anybody at home you can find with free resources. Most of the data you would get with a Bloomberg terminal. You have the same access to information that only professionals had 10, 20 years ago. I think it's important to remember that this is really a golden age of trading. This is a great time to be a trader. Now, have the markets become harder to trade? I don't think so, really. Maybe people talk a lot about like the time tightening up, like everything happening faster and faster. And I don't necessarily see that that's true, but I guess I don't. I remember, maybe more than 5, less than 10 years ago, people were very, very focused on that. And people stopped talking about it. I don't know. I mean, things happen. The subject of market time is another interesting time too. One of the ideas that I've kind of been playing with and can't really quite operationalize is the Greeks had basically several kinds of time, but the two kinds of time that most people are probably familiar with: the chronos, which is like the clock ticking, the second, and then kairos time, which is measured by events. In history, it would be like the change of a president or something like that. And I think I'm sure you've experienced this, haven't you sat in front of the screen all day and it seems like an hour's passed and the whole day's gone. And you're just in it. And then people outside of your time bubble are like, what's this guy doing? He forgot to eat. He forgot to go to the bathroom. I think that market time, and again, this may play with some fundamental aspect of human perception. Market time is much closer to Kairos time. It's much closer to time marked by events. And this is why, our perception of, there are also times that I've been in front of the screen for a few hours and felt like I just fought a battle, felt like I was there for a week. And it's actually, and the thing that I'm kind of playing with trying to quantify is this is related to volatility. And it's not some super insightful thing, because if markets become more volatile, the pace of trading will increase. So your registering, your experience of time passing will change. But that's kind of an interesting aspect of the market experience too.
With that being said, do you feel like you have to use more techniques? Because like you mentioned, information is there for everyone now. So everyone could just open the platform, the trading view or whatever to find the information there. Do you feel like you have to kind of search somewhere else? Or do you feel like you can use the same method as everyone is using or learning about?
As I said, I think I do the same thing. Now, I know it's evolved. We talked about the ways in which it has evolved. But, the amazing thing is that, like, everybody's so secretive, and if now I think there's a place to be secretive. I think the place to be secretive is if you have a precise algorithm, if you have a very precise systematic approach, you probably don't want to share that with the world. And one of the things that we do see, very interesting thing to do, is to look at academic papers when they're published. And people should do that. If you're interested in doing anything quantitative, you should be aware of the research that's published. But the very interesting thing is that the research will come out, and more often than not, it will stop working once it's published. So I think what happens is, there could be several. There are two broad explanations I can see. One is that things are kind of cyclical, and it takes a long time to do a research project. It takes a lot of grad students looking at a lot of data. You have to write the thing, you have to publish the thing. So it may just be that there's a long enough development cycle in publishing research that some of the anomalies, as they would be called, might go away just by natural cycles. Probably not. I think it's more likely that smart traders put those things into practice and they quantify them, and eventually they arb them out. So I don't, when you talk about, do you need to kind of keep things a little bit secret? I don't want to say in all cases no, but the interesting thing is, like, I've been very open. I've written several books. I've written hundreds and hundreds of thousands of words on a blog about how we trade and how we look at markets, and basically still works. And so, and that's, sometimes I sort of wonder why, but I think that I think it goes back to maybe kind of the overarching theme here is that I think we're trading in alignment with aspects of human behavior that, as long as humans are driving financial markets, I don't think can change. People are always going to overreact. They're always going to, and even if you think about a pullback, a consolidation, it's caused by a short-term overreaction. Let's say you have a market at $10 and then the fundamentals change or whatever. People think it, actually, I guess Bitcoin might be a good thing to talk about. Maybe there's no fundamental, maybe just the spirit changes and all of a sudden everybody thinks it should be at a different price. Well, the way it's going to get to that price is with a sharp move on a lower time frame. It's going to go too far, and then it's going to have to sit there and digest the move, and we can trade around that. And I do think, is it possible that some of the adjustments to like stop size and target size and trade selection, is probably some subjective things with trade selection that I've changed over the years. Maybe I'm adapting, kind of riding the wave of that market change, but I also suspect that that's an aspect that's not changing as much as you might think.
So we talked about how much it's important to be discretionary and how much you can kind of overcome algos and even AI that way. But then tell me, like you mentioned, you want to go back to more systematic now, a more mechanical approach with your trading compared to what you were doing before, which was more discretionary. So why is that, and how do you do that process?
Mostly lifestyle choices. I don't want to. I want to take myself out of the decision process. If you're a discretionary trader, to a large extent, if you're a systematic trader, anytime you have a life stress, and the classic thing is a divorce or a serious illness yourself or in the family, you're going to lose money in the market. It's as guaranteed as the sun coming up tomorrow. And I've mentored, I've trained and taught many, many traders over the years. And I've worked with traders that have more experience than I have. And I remember one guy a few years ago had made untold millions of dollars. He was a floor trader, successfully moved to the screen, and his long-standing marriage went south, and he went through a divorce. And I said, "You got to stop trading." And he said, "Oh no." He's like, I know everybody says that, but I've been doing this a long time. I'll be just fine. Yeah, I'll be okay." I said, "No, like you really probably should stop trading." And he did eventually stop trading later that year after he dropped about $4 million. And, so I just know that if thinking about kind of future proofing my trading, taking myself, it's not like are you mostly systematic or are you discretionary?
Yeah, a little bit of both, mostly systematic though.
Okay. So, as a systematic trader, it's not like you're actually out of the decision process. It's people have this misconception that you're going to create a system and then like it just runs. You still are making decisions. You're making decisions about, if nothing else, when to turn it on, when to turn it off, how much risk to put on. But it's a decision that is made a step removed from the market. It's different than, if you're a discretionary trader, you're looking at the market moving. And let's say right now, if you're a day trader, it's certainly right now. But if you're a swing trader, you might be you're putting orders in that might be filled later today, later this week, but you're still interacting with the market with an immediacy that I think I'd like to get away from. But I also might not be able to, like I could see that could feel like pulling myself out of the game. And also, it's a different challenge. All of our statistical work and quantitative work has been really aimed toward supporting discretionary methodologies. So you would, an example of what I would do, and here's a trivial example, but let's say an index makes a new high, a stock index makes a new high. I want to know what the typical behavior is, so then I know how to proceed as a discretionary trader. And if I know that, just broadly speaking, what typically happens when a stock index makes a new high, your near-term expectation turns negative. So if you just randomly bought breakouts to new highs in stock indexes, you're on the wrong side of the market. I need to know that because it can look pretty good to buy some of those breakouts. And I might still buy some of those breakouts, but I would at least know that I probably need to manage them differently. And you also would find that typically what happens after that breakout and after there is that period of negative returns, that then the market continues in the breakout direction. And part of this, you astute listeners are already thinking, well, yes, but stocks have an upward drift, but you correct for that. And so it's not just a case of well, let's say this: you have to do better than buy and hold if you're doing stock research. So all of our statistical work has been put into service to back discretionary approaches, and the challenge of developing and maintaining a set of purely systematic approaches is something that I'm interested in doing it. Part of it is just I won't say boredom, but I think it's not boredom, but it's just seeking new challenges and new horizons.
Yeah, it's all a different way of doing things. And you get to learn a lot more about the market doing that kind of analysis than just by trading it in a discretionary manner, I think. So do you feel like you have to code or you have to learn to code to be able to do that? Or can someone just kind of on their own sort of backtest in the market manually?
It's a difficult thing. I've been asked this question a lot lately. And if you go back on my blog, maybe 2014, 2015, I thought I'm going to write a series of blog posts to teach people to code. Okay, it's a noble pursuit, but the problem is that it's really hard. That's the problem. But not only is it hard, what I become convinced more and more is that it's not just coding. So you do need to be, if you're going to code, the beauty of coding is that it forces you to explain everything to a computer in a very precise way. If you're going to code, there's no, I'm just looking for this pattern. You have to explain it with utmost precision. I think that is a noble pursuit and very good for people to discipline their thinking. Even something trivial like, I want to look what happens if I buy the breakout of every shaved top candle with no wick on top. Well, okay, so you start coding that and then you discover that, well, wait, some of those are really tiny bars. So then there are all of these other things that you start to look at and you realize that some precision is developed there. But before you can get there, you have to get data into Python. You have to have a structure for manipulating the data. You have to have an output module, and you have to have a lot of pieces. And there are pieces of software that shortcut this that many people are aware of. But the interesting thing is that, in broadly speaking, those really haven't revolutionized the business. It's not like you can get. Many of you know, maybe even better than I do, you can get pieces of software where you can test things on a modular basis, or it'll handle every complicated task I just described, and all you have to do is explain the pattern to it. Even TradeStation is a pretty good way to start looking at patterns like that. But what is missing, I think, that also needs to be taught is an understanding of statistics. And this is where I get stuck when I think about teaching it. So first of all, teaching coding is hard. There are a lot of moving pieces. We could do that, but we also need to teach. You don't need to understand complex statistics. None of this is hard, but what you do need to understand are elementary statistics on a very deep level, and you need to understand how numbers can lie, how people will make mistakes with numbers. And that's not so easy to do. So it's been the reason that I've kind of shied away from teaching this, is because I think you have to teach both of those things together. And the degree of understanding, it's not just enough in that silly example with the candles to find that, you'd win. Let's say you'd win 50% of the time. So you might think, okay, well, there's nothing there. But of course, how big was your stop? How big was your target? Did your stop and target change? What data did you look at? What time frame did you look at? So then there are all of these questions and these are the kinds of questions that you can only address if you understand on a pretty intimate level what you're looking at with the stats and what you're pulling out with the numbers. So do you have to do that? I don't think so. I think that there's a lot to be said for paper and pencil. And I do think that people who, even one of the weaknesses, I work with a lot of different people who have different skills. And so there are people who have the skills that I just described. And, some people have training that what I just described is trivial to them. They can easily do that. But what these people many times will be missing is a kind of street smarts, common sense approach to the market. And you get that by actually trading, or you get that by sitting down with a chart. And I say pencil, but you really could be making marks on the screen or dropping arrows on the screen, but just going through manually and doing manual back testing. There's absolutely a place for that. And I think anybody who really wants to understand markets, it's very seductive to be able to write code. However long it takes you to write the code kind of doesn't matter, weeks or months. But then once it's done, you can push a button and you can run 150,000 iterations of a test and you get your answer. And then you make some small tweak and you run it on another 150,000 bars in a few seconds. And, it's really seductive, I think is the word, to be able to look at that much data. And then when you think, okay, well, if I'm going to go through a chart bar by bar by bar, that's going to take forever. But you absolutely are going to get a degree of understanding from the manual back testing, a kind of understanding that might be a little bit hard to quantify, but it's real, that is going to be missing from just the mass quant approach. And I do think, in fairness, most people who do the hand back testing probably could learn more if they did some of the hardcore quant work, but it's a pretty steep wall to climb. And I don't think you have to do it to be successful as a trader.
At the same time, there's a lot of variables that you're not really aware of when you do your back test. With the script automatically, there's some things you might not think about, and then you see the chart and you realize, oh, I forgot that part. And that's something you have to add to your code. So that takes a lot of time for sure, from experience also.
Yeah. And sometimes, the real challenge is there's always going to be mistakes, and it's nice when the mistakes are easy to find. When you run code and the results are just too good to be true, and there's that little split second where you're incredibly excited. And you're like, okay, what country am I going to buy next week? And then you realize, or maybe there's a problem with my code. It's nice when they're easy to find like that, but sometimes there are problems that are much, much harder to find, and you can get. I've certainly had things that I've actually pushed the button and traded things that had problems behind them, and you don't find out until the market lets you know.
Interesting. So we covered a lot here, but what can people find if they connect with you or reach out after the interview? Where can they learn more about what you do and all your good work?
So Twitter is, and I'm trying to force myself to use Twitter more. Twitter is a good central place. At adamhgrimes.com. Follow me on Twitter, and when I write a blog post, I will tweet about it. I also have my blog, adamhgrimes.com. I've been doing this a while, so I'm pretty Googleable. Is that even a word? I'm sorry, I just made that a word. But you can Google me, and any most technical terms, like if you want to see work I've done on moving averages or RSI or Fibonacci, you can Google that plus Adam Grimes, and it'll pull up links to my blog. And like I said, I'll probably be sharing some more music soon for people who are into that. But just follow my Twitter. That's pretty good hub.
Awesome, very cool. And you do put out a lot of good information about things in the market. I know you had a course before that was really complete and a lot of things inside. So that was really good. You still have that, by the way, or
that course is still out there, and we're actually just today we're thinking about making some changes to it and maybe making a couple different steps that might make it a little bit easier to get into. But yeah, I had this course that I put out. It's kind of a funny, I don't know if you know this. I might have told you when we talked before, but I had some friends who were absolutely abused by some of the online, I have to be careful what words I use, by some trading educators who recently ran afoul of the regulators. And I had this friend in particular who had spent $25,000. And not only did he learn things that everything he learned, you could have learned from a book, but a lot of what he learned was false. He was just simply taught things that weren't true. And I saw this happen to several people, and they were all spending 5 figures, more than $10,000. And I said, okay, you know what? I'm going to make a trading course that's better than this garbage that these companies charge for, and I'm going to put it out for free. So that was Yeah, that was kind of I try not to swear on podcasts. That was my FU to a lot of the scammy trading educators. So that's why I put that course out. I think maybe it made its debut in 2012, 2013. We've had tens of thousands of traders have been through it. And even some universities have contacted me and they've adapted sections of the course for some of their finance coursework. So that gives you an idea if you haven't seen it. You can find it at marketlifetrading.com. But if you find my blog, you'll easily find the way there. But the course is at marketlifetrading.com. It is still free. It will always be free. It's a very rigorous approach to trading. It will, if you do it right, it will require weeks. I think there's I don't know, maybe 40 hours of video. There's hundreds of pages of PDF exercises. And it's not the right approach for everybody because it is, if you think about this, so Jack Schwager is probably a name that you know, the Market Wizards guy. I remember when I started reading Market Wizards back when I was aspiring to be a trader, and Jack said that one of the ways that he basically kept people from being traders, kept not serious people out of trading, was he wrote this book, A Complete Guide to the Futures Market, which, by the way, I would recommend. I have 2 versions on my shelf behind me. And in fact, I think I can point to it right there. Yes. But it's such a, I don't know, 600-700 pages. It's just a monster of a book. And if somebody would come to Jack and say, I want to be a trader, he says, okay, great, go read that book and then come back to me after you read that book. And nobody ever came back to him. Nobody finished the book. And, you know, I don't think that it's good to put up like, you know, exclusionary things like that nobody can get over. The course is, you know, it's on that scope. You're going to spend, if you do it right, it's probably going to take 100 hours of your time. But the other thing I can tell you is if you do it right, it's going to radically change the way you see and think about the markets, about your trading, trading plan, discipline. And so it covers everything from quant stuff to psychology. It's all in there. So check it out, marketlifetrading.com.
Awesome. Very good work, by the way. And that's something I'd probably take you a lot of time to do also. So not just the recording part, but the part of planning everything out. And that's just insane. So well done on that. That's awesome.
It was a labor of love. And we did, I completely reshot it about 3 or 4 years ago too. So it's in a completely new version, but yeah.
We'll put a link below the video for people to check it out if they want after, and they can just check it out and yeah, definitely go through it if they want. So thank you, Adam. I appreciate your time. I think it's been awesome to catch up and look forward to catch up with you quite soon.